Do you know who decides your insurance rates? It's not your insurance company. It's not even computers at your insurance company. It's the computers at the company that insures your insurance company. That's who's really pulling the strings. And once you know how it works, you can actually take some advantage of it for yourself. I'm Josh, software exec with almost 2 decades of experience designing, building, and running software companies. And on this channel, we go behind the curtain of the software industry. Okay, so a few years back, I actually wrote some of the software for one of the biggest reinsurers in the world, which is what led me down this whole insurance rabbit hole to start with. You see, one of the first things that I learned was that insurance companies aren't the real decision makers. In a way, they're really just a middleman, because insurance is a risk business, right? Every time an insurer approves a policy, they're kind of making a gamble. And the gamble is that you'll pay more in premiums than they'll ever have to pay out. They'd call it a calculated risk, but it's gambling. And I know your brain probably jumps straight to things like medical insurance, especially if you're in the US. But let's use something a little simpler as an example. Let's use flood insurance, because it's something that's pretty important where I live, and it's a really good, simple model. Let's say you apply for flood coverage. Your insurance company, they look at your property, your area, the elevation, flood maps, all the usual data, right? And they model that risk, right? So they crunch some numbers. And what they come out with is, this person, they have X dollars amount of risk, so their premium will be Y dollars, right? And that all seems pretty straightforward. That's what we expect. But they're not doing that just for you. They're bundling your risk with thousands of other homes and properties in your region. And so they're spreading that risk across the entire pool. And what that means is if 5 houses flood, they have to pay out, right? If none flood, they keep all the money. And if one floods but everyone else is fine, then it balances out. And that's their risk profile. That's their risk mitigation. But let's say a tsunami hits, right? Suddenly every home in the entire pool all get wiped out. And now suddenly your insurance company is paying out on thousands of claims instead of just 5. And this is what I learned is called a tail risk. It's kind of a catastrophic event. And the scary thing about a tail risk is that your insurance company can't actually afford it. They can't afford to pay out on that. So what they do is they buy insurance for themselves. And that's where reinsurers come in. Before we go in deeper, hit like and subscribe. It's free, and it really helps get this kind of content in front of more people who have no idea how software is shaping their lives. So reinsurers are the companies behind your insurance company. They're the ones who step in when disaster hits and cover your insurance company's losses. Because, like your insurance company model risk across their region, the reinsurer has that risk spread across the whole world, across pools of thousands of insurance companies. So where you're insuring your house, right, and your insurer insures your entire region, the reinsurers insure entire countries, right, continents, whole industries, and they bundle risks at massive scales, which allows them to cover costs and premiums that are, tens and hundreds and thousands of times higher than what you and I would normally see. Unlike your insurer, reinsurers aren't dealing with just a couple thousand policies, right? They're dealing with millions all over the world. And so that means they have to be really, really accurate with those risk calculations, right? With that gambling they're doing. They have to know it down to the 0.0001%. And that is where computers take over. Because the reinsurers, they're not sitting around with spreadsheets, right? They're not guessing at this risk, by hand or just adding numbers on a calculator. They use really massive, really global data models, really big computer calculations to help them with this. And this is exactly where I was writing software. And it's really where I started to kind of find out that it's actually the software, it's actually the computers and not the people that's deciding the risk. So sure, there are people still reading and interpreting that information. Sometimes it's not fully automated, but oftentimes it actually is. Software is the thing determining the premiums. It's deciding who gets insured, at what price, and what the insurer is willing to gamble. So your insurance company, they're just kind of passing that information downstream to you. At least it's severely limiting what they can do and what they can offer. So when you go and you apply for insurance and your insurer gives you your rate, what they're actually doing is they're just passing along a risk profile that was generated by their reinsurer's algorithms, right? It's not your local rep. It's not even their CEO, right? It's not even their computers. It's the computers running at the reinsurer on another continent somewhere that are pulling the strings. And that's where this whole thing got really interesting for me. Because once I realized that the reinsurers or the real brains behind the whole operation, not the companies that we're interacting with, it kind of flipped the entire script. All the things that we think matter really don't, and the things that you don't necessarily think about, they're the things that the computers actually care about. So the more I dug into this as I was writing this code and setting up these systems, the more it kind of clicked, right? Insurance companies, they're not judging you. They're judging the pattern that you fit into. So the reinsurer who's collecting all these things, they don't know your name, they don't know your story, they don't know you're, a responsible person. They just see kind of a profitability inside of a risk cluster. And so what I was thinking is, okay, if these systems are grouping me with thousands of people, then my goal, it's not to find a good insurance company, it's to get grouped with better patterns and with better, safer groups, right? And weirdly enough, you can actually do that. So the little things that don't feel dramatic day to day, things like your credit score, your claims history, or home maintenance, or the safety improvements, or even more specifically, things like your zip code, all those things, they kind of nudge the algorithm in one direction or another. And even bundling. I always thought bundling was just a marketing ploy, right? But no, they love big, stable bundles, right? The bigger the pool, the smoother that risk curve. So you actually get sucked into a safer group when you bundle. So by doing all these little things, right, they each add up. And you can kind of add those up to get yourself into the safest group, the safest policy that you can, and in theory, into the safest insurer that you can, right? The ones who have the lowest risk profile overall, right? If there's an insurance company insuring a lot of risky individuals, they're going to be forced to give higher premiums, even to the people who aren't a risk. So when you start to see the systems through that lens, and you start realizing that, the whole game isn't convincing your insurance company that you're responsible. It's more about getting yourself into the lowest risk group and the lowest risk insurer so that the reinsurers' algorithms are bundling and allowing the best rates to whoever's providing them to you. So if you found that interesting or helpful, don't forget to like the video. Share it around, it's free, and it gets this kind of information out there so more people know how these things really work. And if you'd like to see more videos on software and the tech industry, follow the channel because there'll be more coming soon.